We live in a world where money feels tangible. It buys food, pays rent, and secures futures. But peel back the surface, and money is nothing more than an illusion, a shared belief that green paper, digital numbers, or metal coins hold value. Without trust, that illusion collapses instantly. Think about it. A $100 bill is only cotton fiber with ink. Its worth doesn't come from the material, but from the collective agreement that it can be exchanged for goods and services. Throughout history, civilizations have discovered, sometimes painfully, that money is not wealth itself. It is a symbol, a promise, a psychological contract. The United States dollar is the most powerful example. It dominates global trade, stores value for nations, and influences geopolitics. Yet the dollar is not backed by gold or silver. Since 1971, when Richard Nixon ended the gold standard, the dollar's strength has rested purely on faith in the American government and economy. If that faith wavered, the illusion could shatter. This is the paradox. Money rules the world, but only because we collectively agree to let it. Behind every empire, every market boom, and every collapse lies a simple truth. Money has power only as long as people believe it does. The illusion of money isn't new. Thousands of years ago, civilizations invented tokens, shells, and coins to simplify trade. In Mesopotamia, clay tablets recorded debts long before coins existed. In China, paper money appeared in the Tang Dynasty, centuries ahead of Europe. Every system had the same foundation: belief. A cowrie shell wasn't inherently valuable, but communities agreed it could stand in for grain, cattle, or labor. Roman coins weren't just metal. They bore the emperor's face, a political guarantee that the state backed their worth. Yet history shows that when belief faded, currencies collapsed. Debased Roman coins, filled with cheap metals, sparked inflation and mistrust. In 13th century China, when emperors printed money without restraint, runaway inflation crippled dynasties. What makes these stories timeless is that nothing has changed. Today's dollar isn't tied to precious metals, just like Rome's coins eventually weren't. And like ancient citizens, we trust because we must. Without belief in the system, trade halts, societies fracture, and governments crumble. The deeper lesson? Money has always been a mirror of power. Whoever controls the illusion, whether emperor, banker, or government, controls the people. For centuries, gold was the anchor of trust. It gave money something physical, something unchanging, to tether value. Nations tied their currencies to gold reserves, creating stability in a volatile world. The United States formalized this in the 1944 Bretton Woods Agreement, making the dollar the global reserve currency, pegged to gold at $35 an ounce. But this tether was fragile. By the 1960s, America spent heavily on wars and welfare programs, printing more dollars than it had gold to back. Foreign governments noticed, demanding gold in exchange for their dollar reserves. U.S. gold reserves dwindled. In 1971, President Nixon made a shocking announcement. The U.S. would temporarily suspend the dollar's link to gold. That temporary measure became permanent. Money was no longer gold. It was faith. Since then, the dollar has survived not because of metal in vaults, but because the world believes in America's economic might, military power, and political institutions. Yet the shift also opened the door to money creation on an unprecedented scale. Central banks could print at will, governments could borrow endlessly, and inflation became a permanent shadow. The gold standard's end was the ultimate proof. Money is an illusion, and its survival depends entirely on trust. After the gold standard ended, governments embraced fiat money, currency backed by nothing but decree. Central banks could expand money supplies freely, financing wars, bailouts, and programs by issuing debt. The illusion grew stronger, but also more dangerous. During financial crises, printing presses turned faster. In 2008, the Federal Reserve injected trillions to stabilize collapsing banks. In 2020, during the pandemic, governments worldwide printed vast sums to support citizens and businesses. These measures saved economies, but at a cost. Inflation surged, inequality widened, and public debt soared. Fiat money works as long as people believe it does. But history shows the risk. Weimar Germany printed marks until citizens needed wheelbarrows of cash for bread. Zimbabwe followed the same path in the 2000s. When belief breaks, hyperinflation is the inevitable result. The question lingers: how far can the illusion stretch before it snaps? If fiat money is belief, credit is belief squared. Modern banking allows institutions to lend money they don't fully have. Through fractional reserve banking, a single deposited dollar can generate multiple dollars in loans. The illusion compounds. This system fuels growth. Americans buy homes, cars, and education on credit. Businesses expand using borrowed capital. Governments fund budgets with debt, promising tomorrow's taxpayers will pay. In truth, the modern economy is a pyramid of trust. Trust that borrowers repay, trust that banks remain solvent, and trust that governments honor their debts. But trust is fragile. The 2008 crisis was a reminder. Banks packaged toxic mortgages into safe investments. When borrowers defaulted, the illusion collapsed, threatening global finance. Only massive government intervention restored confidence. Credit isn't inherently evil. It creates prosperity. But it also magnifies the illusion of money to dangerous extremes. Our prosperity rests on a foundation that can vanish if confidence falters. Today, most money isn't paper. It's digital. Bank balances, credit transactions, and cryptocurrencies all exist in cyberspace. Less than 10% of the world's money supply is physical cash. The rest is code in servers, invisible yet powerful. This raises unsettling questions. What happens if power grids fail? If cyber attacks erase balances? If confidence in digital systems disappears? Cryptocurrencies like Bitcoin emerged as a response to this fragility. Advocates claim they offer real money, independent of governments. But even Bitcoin is an illusion. Its value swings wildly because people choose to believe in its scarcity. Without that belief, it's just code. Governments, meanwhile, are developing central bank digital currencies, CBDCs. These could reshape control, giving states unprecedented power to track and manage every transaction. For some, it's efficient. For others, it's dystopian. The illusion evolves. From shells to coins, from paper to pixels, money's form changes. But the underlying truth remains the same. It only works as long as we all play along. At the core of every empire, every bank, and every household budget lies the same fragile truth. Money is belief. It isn't gold. It isn't paper. It isn't even digital code. It's trust in systems, governments, and promises. When that trust breaks, history shows collapse follows quickly. Rome fell as its coinage debased. Weimar collapsed under hyperinflation. The Soviet Union imploded as its economic promises failed. The dollar endures because billions of people, from investors in Tokyo to merchants in Africa, still believe in it. But illusions are delicate. Rising debt, inflation, political division, and technological upheaval all test the boundaries of belief. Could there come a day when the dollar loses its aura? When the illusion shifts elsewhere? Perhaps to gold again, or digital currencies, or something entirely new? Money's greatest trick is its invisibility. We rarely question it because our lives depend on it. Yet understanding that it's an illusion doesn't make it weaker. It makes us wiser. If money is belief, then the real wealth is not the paper in our wallets, but the productive capacity of societies, the trust between people, and the stability of institutions. Money is just an illusion, but it's the most powerful illusion humanity has ever created. And the day we forget that may be the day the illusion breaks.